Hello, everybody. Good morning, good afternoon, and good evening. My name is Leoncio Montemayor. I'm a project manager at Solarplaza, and it is my pleasure and my honor to be here today, hosting this webinar on solar cannibalization in Spain and other market parity countries. Our speakers for today are Kim Keats, director at Econ, and Manuel Cabrerizo, partner at Baltic. I think this webinar is just going at the right time. I think we all know that solar is the cheapest source of energy around the world. And what does this mean? What does this mean when we start installing a lot of solar around the world? For example, in these market parity countries such as Spain. So to start off, I would like to first ask a question to the audience. So we're gonna do a sort of a game where we'll see what we learned during the webinar. So I'm gonna launch a poll right now, and you should be seeing these on your desktop. And the question is basically, what is the most important thing to understand while developing or financing large-scale PV projects in, let's say, Spain? So number one is regulatory framework, market dynamics, such as prices projections, availability of PPAs, managing the merchant risk, or understanding the cost drivers. So I'll give 1 minute and we'll show the results. Thank you. I mean, we are basically doing this. We're going to do this now and at the end of the webinar to see how sort of the knowledge changed. I think it's going to be interesting because, well, we haven't come across the topic right now. So it'll be interesting to see what we all learn. So, well, we can see here the initial results, regulatory framework, and market dynamics, so understanding price projections as the clear winners in the most important things. Okay, perfect. Let's take this and review it later. So this is the agenda for today. I'll start with a brief introduction, which I already started, and then we'll go directly to the presentations by both of our speakers, and then we will finish with the Q&A with both speakers, so make sure to stick around. And then we'll finish the webinar. So we're doing this webinar in the run-up to our event, Solar Market Parity Spain, which will be the 14th of March in Madrid. We're expecting more than 200 high-level attendees, both from national and international developers, investors, manufacturers, and consultants. I think we all know that the Spanish PV sector is shining again. And we are gonna have the right networking tools, and well, of course, this is happening in Spain. Sorry. This is for some of our sponsors. Our diamond sponsor, Sungrow, our registration sponsor, Voltic. We're partnering up with UNEF on this event, and we also have other gold and networking and branding sponsors. So if you want to partner for this event, feel free to contact Laura. Laura at solarplaza.com or her phone number over here. And we're still in time to partner up for this event. This is just a little bit of the program. We'll start with the pre-conference networking dinner with some tapas and music the day before the event. And then during the day of the event, we'll include, these are some of the key topics, wholesale electricity prices projections, the auctions, talking about greenfield development, hybrid transactions, PPAs, grid considerations, and more. And these are some of our speakers. We have even more content on our website, spain.solarmarketparity.com. We have a Spain country report. Check the chat box right now for the link to the country report. We also have a mappa, which is a map of PPAs, and we have interviews and more webinars and more content. So feel free to check our website. And for those of you who don't know Solarplaza, our mission is to positively impact the world by accelerating the sustainable energy transition. We do this by organizing high-level events. We've been doing this since 2004. We've organized more than 100 events in more than 30 different countries. And just final notes, if you have any technical issues, please use the chat box, and Marco here will help you out. If you have any questions for the speakers, please use the question box, and we'll come back to the questions at the end. And for all of you who are wondering if there's going to be, if the slides and the recording will be available, they will be, and we will send them afterwards. I would like to introduce our first speaker of today, Kim Kitts. He's a director at Econ Strategy Consulting. He does market modeling, so he prepares market studies to support and inform financing, refinancing, IPOs, and M&As of power, fuel, and water desalination projects in Europe. He previously worked at ICF International on the economics and IPA energy and water. And he has supported more than 47 gigawatts with a transaction value of 32 billion US dollars. So Kim, the floor is yours. Please give us a great presentation. We're all very excited.
Thank you, Leoncio. See if I take control. Right, the context. I'm going to talk today in the context to try and set a little bit of an introduction to why are we interested in a particular topic. Second, and then I'm going to talk a little bit about cannibalization in a theoretical context, so we all know what we're talking about, what the main drivers for this particular phenomenon are. Then I'm going to show you some information which should be useful because it actually shows you how cannibalization actually works. Right, we don't have necessarily a duck curve for Spain, but I'll get pretty close. I'll show you how it is that actually does have an impact here. And then the question is, as we look towards the aggressive deployment of renewables to meeting the 2030/2050 carbon reduction targets, is there a particular end game for this cannibalization? And that's what I want to leave you with, a series of questions for discussion, which hopefully Manuel will be able to pick up on immediately thereafter. So since you're getting the presentation, I'm not going to spend a lot of time talking about doing introductions, so let's worry about that. From the context, just remember that we're based in Spain, so we've been looking at the market for over 20 years. Now, to begin with the context, we've had a situation where historically the deployment of photovoltaic in particular has been financed or deployed through the use of a government support. That has changed radically with the fall in the capex of new photovoltaic. Right? I mean, the Spanish government got into a little bit of a knot in around 2008 when a lot more capacity came online than they had originally expected, and putting sort of budgetary pressure, especially through the tariff deficit, which some of you may have heard of. I'm not going to go into any of that detail now. But let's say that things are changing in the sense that the deployment of photovoltaics in Spain is being now much more focused around what will the market provide for this type of technology. So my interest, at least the way I'm trying to provide feedback on this particular issue is, can you bring it into context of what would photovoltaics do in a sort of market context? And what I mean by cannibalization, just from a definitional perspective, is as it says in the third bullet point, right? We're deploying new photovoltaic plant, which in itself undermines the economic case because it results in a drop in wholesale prices and therefore the remuneration. And obviously the big question is how can we explain this? Where can we arrive to, this goes badly? So I suppose we talk a little bit about the Spanish electricity market. It's a liberalized market. We use the sort of concept of the net pool. Again, I'm not going to go too much into detail, but note that in this context, bilateral contracts, including PPAs, can be either financial or physical, right? So in the context of how do we negotiate hedges against volatile spot market movement, there are going to be mechanisms that are going to be available for you. So we already have a forwards market through a MEP, but we're also going to have bilateral contracts. I'm just focusing on what's going to happen in wholesale electricity spot market. Now, lots of things affect electricity prices, demand, supply. I'm an economist, so I can talk about those issues always as a point of reference. So there are some aspects which influence the cost structure on the supply side or the availability. So if there's sunlight, that's going to affect obviously the potential dispatch for photovoltaic. If we have hydro, that's going to affect the ability for hydro to dispatch, which influences the weather. The weather always influences demand, etc. So there's a whole bunch of feedback loops But this, doesn't mean that we're going to get to a situation where everything's impossible to understand. And the answer is, well, no. And let me try and give you a little bit of an insight into that. In the top right-hand chart, you have the actual hourly prices for 2007. And as you can see, it's just a big zigzag line. One thing to point out, however, is that the prices haven't really collapsed at any specific point in time, or the incidence of very low prices is actually quite limited, right? And if you look at the bottom, you've actually got the equivalent dispatch of different types of capacity. So demand is jumping up and down very aggressively as are prices evolving over the period of time. What can we tell from these charts? The answer is not very much, other than prices are higher in the winter than in the summer. Okay, that's about as much info as we can draw from these charts. However, if you get the magnifying glass and start looking in more detail, you'll be able to see what it is that the evidence for cannibalization. So it's going to give us a context. And for that, I'm going to show you how it is that the electricity market works in theory, right? And try and give you a bit of a feel to what's going on mechanically within the electricity market for you to see what it is that's actually happening. So let's think of a particular situation where we have a series of power stations providing their capacity into the market. In this case, I've got A, B, C, D, E, and F, which happen to be the individual power stations. The height of these boxes is reflecting their short-run marginal cost. It's just whatever the operational cost is. And in this case, there are no renewables. Okay, so let's just assume there's low cost. So A could be, for example, cogen, and B could be nuclear. C would be, say, coal, and then gas-fired facilities would come thereafter. Everything depends on carbon dioxide costs and things like that, but we'll leave that aside for now. When you rank all the power stations in this order, you come out with a supply curve, which is the equivalent of the merit order curve. And if you know what the level of demand is, the intersection between demand and supply is going to give you the price of that particular horizontal line. Now, on that basis, the profit that is being made by each of these individual entities, which is dispatched, in this case, plants A, B, and C, is indicated by the area underneath the price curve. So you know how much money people are making. What's going to happen, however, if you have renewables suddenly coming on? So this can happen because they're actually being built, or because, let's say, the sun begins to shine or the wind begins to blow. And in that case, what happens is the whole supply curve is shifted to the right-hand side. Now, if you have as a point of reference the price before the available renewable supply was actually dispatched, you'd be thinking to think that if you're building a photovoltaic plant, which has by definition zero cost, or very, very low marginal cost, by the way, this is without including the capacity, or capex investment, you think you're going to make a whack of money. It doesn't matter what the actual amount is. You just think, well, I'll be able to monetize that. But as a matter of fact, because you've come into the market with additional supply, you actually drop the price. So instead of having the price being set by the plant D, you actually see a drop in the price, and it's actually plant C which is setting the price. So you see, in this context, you're actually losing a significant amount of money. This is one of the major risks of any type of renewable generator that is being marked against a price, a market price, because you're basically a price taker. You're basically waiting for someone else to set the price which you are likely to be receiving. Not only do you have to worry about how their costs are moving up and down, you have to worry about your own dispatch, because your own dispatch results in this issue of cannibalization. And you can see that in this context, the amount of money being made without the available renewable resource being dispatched is lower for the existing power stations as well, not only for you. So bear that one in mind. Now, and the more interesting thing about this is because of the interruptible nature of renewable energies, wind and solar. I say interruptible because obviously there's cloud, although we have an expectation that the sun shines only in the daytime, not at night. Wind's obviously got a slight advantage over us from that perspective. But the thing is, we can have the same situation occurring within the context of a single day, with the sun coming up, and then we're going to see prices falling exactly when we actually want to be dispatched. That's one of the challenges in the short term. Can we actually see some of this happening in the real world? Simple answer is yes. Don't try and look at the zigzag line over a period of 8,760 hours in the year. Do it in the context of a day. And I chose a day that's very special to my mother, which is the 12th of September, which happens to be my birthday. So on the 12th of September 2017, on the top left-hand side of this chart, you'll actually see the dispatch levels of the different technologies in Spain, right? And overlaid on top of that is the black line, which is actually the price line. So that's actually the Spanish spot market price. If you take the hourly generation of everyone except the wind and the solar, you take them out, and you map it against the prices, you have the sort of XY plot that you have in the bottom left-hand corner. The bottom left-hand corner shows you quite clearly that as the amount of generation from renewables, right, in this case wind and solar, decreases over time, you actually get an increase in the price. Okay, so the more wind there is, the more photovoltaic there is, those are associated with periods of lower electricity prices. That's exactly what we would expect from the theoretical framework I just showed you immediately beforehand. Now, that's fine. Can we see this particular picture over a longer period of time? Or am I just inventing it? Is this just a complete fluke that my birthday worked out fine? The answer is no. It works over longer periods of time as well. I wouldn't necessarily recommend you to do it over the whole of the year, because there are all sorts of things that change within the year that impact the cost structure of those power stations that set prices, right? So you're going to end up with a scattered chart, which will be in the same shape as the bottom right chart here, but it'll be more messy. This one is just taking all the hourly results for September 2017. The chart on the top, it shows you the black squiggly line, which is actually the prices, and then I've aggregated under others all the other technologies which are not photovoltaic and wind, right? And again, you can still see quite clearly if you do the XY plot of the hourly generation excluding wind and photovoltaic against the S&P in the Spanish market, you see that there's a inverse relationship between the photovoltaic dispatch and the wind dispatch and the actual price. To the extent that a reduction in 15 gigawatts in the production from photovoltaic capacity actually led to a drop in prices of about 23 euros per megawatt hour. Okay. Does that mean that we can interpolate and use this calculation for saying if we have, say, 45 gigawatts of installed wind and installed dispatchable wind in the market? And the answer is no, I would not go that far, because every time, as I said before, the prices are being set not by the photovoltaic and the wind capacity per se, they're actually being set by thermal plant, which is forced to run, with a degree of flexibility that the hydro system here in Spain is actually using. But anyway, we don't want to get into regressions or any sort of correlation analysis at this stage. This was just an illustration of the fact that there's a very clear relationship between the higher dispatch levels of photovoltaic, as will case, and in this case including wind, because we only have about 5 gigawatts of installed photovoltaic in Spain. So you have to add the wind, which is much more significant. You can actually see very clearly what the impact is going to be between these two low-cost sources. And that's what takes us to the effect of what they call the duck curve, right? And for those of you who have not heard about it before, it's a concept that arose from the California ISO, Independent System Operator, which was doing an analysis in 2012 or thereabouts. So they had the curve that looks here at the top end of this. And if you look at the top end, it looks like the back of a duck, with the duck walking from left to right. And then as more photovoltaic capacity was going to be deployed in California, and this was a forecast, by the way, it's not in real life, it's actually slightly different, but this was a forecast that they were making as to what things would evolve as they move towards 2020. And so the lower curve in the middle of the day, that's actually the photovoltaic dispatch sort of dropping the actual demand. So this is not a price curve. This is actually a curve which represents what's going to happen to demand. But because demand tends to be correlated with pricing, the higher the prices, the higher the demand, they go hand in hand, and vice versa. So the expectation is that prices will fall within the middle of the day. You can see this type of effect in other places which have got competitive wholesale electricity markets like Germany or Italy. It's not particularly new from that perspective. Now, so we've had a little look at how cannibalization can work in theory. We have a little look at whether there is actual evidence of cannibalization, even though in the Spanish context it's still early days. And the question then becomes, how will cannibalization play itself out? Is it a new concept? And the answer is no. The most important thing, one of the important takeaways I'd like you to bear in mind is, cannibalization is not itself a new thing. There are plenty of markets where developers and investors have been too keen to invest. Particularly, it tends to be quite uni technology based. So everyone decides it's a good idea to build coal-fired power stations, right? So everyone builds coal-fired power stations and they overdo it. Result, the price collapses. Everybody builds CCGT, combined cycle gas turbines burning natural gas, and they overdo it and the prices collapse. And there is obviously evidence of that in the Spanish context, where we have a very sizable installed generation set of combined cycle power stations, which most of them don't average above a 5% load factor every year. Okay, so there's evidence of waves of investment coming in. So the idea that there is too much investment of a particular technology and they all effectively undermine their own economic case is actually a well-known fact. Okay, so it happens in different countries for different reasons, different motivators around it, but just be aware that this is just another one of those games. So if you do know about the instances of oversupply arising in the market, you could apply it in the context of Spain. So the question then is, does this have an end game? The answer is, I would suggest, yes, there is at least a theoretical end game where things shouldn't get any worse. And the question is, well, how can they get any worse than you telling me the prices are zero in the middle of the day? And the answer is, well, the thing is, if the prices really were zero in the middle of the day, the fact of the matter is, you wouldn't have invested, you wouldn't have made the capital investment in new photovoltaic, knowing that you wouldn't be able to recover your investment cost, right? I'm an economist, so I'm allowed to think in this concept of equilibria, by the way. So the issue is, what's going to happen? And the answer is, I mean, conceptually, there's a point at which the photovoltaic market will be, or the amount of photovoltaics in a particular market will be saturated. And that point is when the realized price of the photovoltaic capacity is actually equal to its all-in investment cost. And I'm going to try and explain that with the use of a little, very simple technology example, okay? Let's think of a very simple model with a 24-hour window where we have gas-fired combined cycle setting the prices overnight. If you think in the context of, I don't know, somewhere in the Middle East, you wouldn't be too far wrong. On the other hand, this actual model is not too far wrong in Spain as well, because we have a lot of combined cycle capacity just waiting for the coal power stations to close down. So the reference point to a gas-fired combined cycle, at least the marginal cost of operating them, is actually quite relevant. And then what we're going to do is say, look, how are we adding capacity to this particular system, and what's the impact going to be? So this chart's a little bit different from the one that we've seen before, because the others were real numbers. This is just me drawing some pictures on a whiteboard. Okay, top left-hand chart, you've got the representative demand in the sort of browny red color going up into the middle of the day and down the other side. And in this context, we have a little bit of photovoltaic PV1 coming in the middle of the day. Okay. The difference between the brownish curve and the blue curve, that area between, has to be completely filled in, quote unquote, by gas-fired combined cycle. So what is the price that would be, or what technology would set the price within this window between the two lines? The answer is it'll be a CCGT. Therefore, we can look at the bottom left-hand chart and see the blue line that runs across, which indicates the level of the short-run marginal cost of combined cycle power station. All right, if you're trying to work that one out quickly in your head, you just get the euro per megawatt hour fuel equivalent price from any website that you want, or the CME, or ICE, and you just multiply that number by 2. You multiply the number by 2 because the thermal efficiency of a combined cycle power station, at least the more efficient ones, is about 50%. So that means that they need 2 units of fuel for every 1 unit of useful electricity. Anyway, we just referenced line. All right, whatever it is, it doesn't really matter because it'll change with costs. What happens if we increase the amount of photovoltaic? And the answer is, well, at first, not very much. If we build a little bit more photovoltaics and we jump from a PV1 to PV2, on average, these are meant to be average curves. We saw the volatility, but just ignore that for now. Just follow the trend, you know, the bell-shaped curve for now. So the bell-shaped curve just gets elongated down the middle, and when PV2 is giving us more dispatch. Fantastic. However, we're still getting, we still have a need for a combined cycle power station in the middle of the day. Therefore, the price is still unmoved from what it was with the PV1 situation. When does this game begin to change? And the answer is when you have enough photovoltaic such that it begins to set the price. In other words, what happens is you get a, let's say that in this case in PV3, you actually have a collapse. Everything gets met. All the demand in 1 hour or in the middle of the day is actually being met with PV3. Right, at that point, PV is basically you're gonna see a collapse in the price. So for 23 hours of the day, you're gonna have the price of combined cycle power station, but for 1 hour, the price is gonna be zero. Okay. And what if we continue adding more photovoltaic? The answer is, well, the curve will actually jump above the level of expected demand. By the way, if you're thinking about context of storage, why do we need storage? For this reason. This is one of the reasons, because the only way you can expect zero prices all the time is that sure as hell is going to be too much electricity on the system, and that's when you want to try and buy that low and sell it high at nighttime. But I'm not here to talk about storage economics. I'm just trying to show you how this is going to work. Now, so focusing on the red PV4 line, wherever the lines are intersecting with the daily demand profile, that window of time between those 2 points is actually going to give you zero price, which is why on the bottom you see this sort of U-shaped price curve. And what's going to basically happen is we have more hours where the price is effectively zero, and then the rest of the time CCGT. Now, where this game will stop at some point in time. Obviously, we know that nobody's going to develop photovoltaic on a commercial merchant basis if they think that on average the price is likely to be dropping below whatever it's going to cost them to build the power station. So it's a sort of weighted average. That's what I mean when I talk about a realized price of photovoltaic. It's actually a weighted average. You have to cross multiply the dispatch of the photovoltaic by whatever you think the hourly spot price is going to be. Okay. For those of you who have been looking at the Spanish market, there's this concept of apuntamiento. Okay. I lived in Venezuela as a kid, so I speak Spanish, by the way, in case you're wondering, even though I've got a completely English name. So the apuntamiento is basically the ratio of the realized price for the photovoltaic divided by the base load electricity price. Right. And one thing is that's fine, but it's basically trying to tell you is as cannibalization becomes more prevalent in the Spanish market, right now, the level of this ratio of apuntamiento is actually, you know, zero. There's no discount to solar. Solar actually gets a little bit of a premium, quite small, nothing to write home about. It just happens to be that way. Some years it's been an 8% premium. 2017, I think, was close to zero. Right? It varies, even though there's been no change in capacity. But things change, and when you get dispatch matters, and it just happens to be that particular way. So over time, this level of apuntamiento, other things constant, should be dropping. So this ratio should drop, and therefore, in absolute terms, you should be getting a lower price of photovoltaic. But the level of apuntamiento, in my opinion, is not really the helpful benchmark. The helpful benchmark is, you know, how quickly are we going to get to this point where the realized price is equal to what it cost me to build the photovoltaic plant on an ordinary basis. Okay. Now, the thing to remember about this equilibrium, which I am trying to draw in your mind, is that there is no missing money problem. The missing money problem is whereby you have these targets, or you have this intuition that there should be 40,000 megawatts of new capacity photovoltaic in the Spanish market, but you have no idea how to pay for it because it implies a complete collapse in the electricity price. And there are some studies that have been done which look at the government targets and suggest that the realized price for photovoltaic energy, you know, could drop as low as 10 euros per megawatt hour. But that makes no sense to me because you have a huge missing money problem. Okay, so you just don't have enough capacity. So that takes us away from the from the theory and a little bit of the practice, and some sort of concept as to what it is that an end game for this cannibalization should be, as long as we're acting rationally. Again, I'm an economist, so I'm allowed to use strange concepts such as equilibrium and rationality. So here's a list of questions just to finish off with, right? What is this point of saturation in the Spanish market? Does it exist? Does it mean that, is it 15 gig or is it 40 gig? The answer is it depends. It depends as you look forward in time. It depends how quickly we close the coal-fired power stations and the nuclear power stations. It depends how quickly eventually all those pretty new combined cycle power stations begin to close. So it depends on a number of drivers. How quickly will we get there? It depends. I don't think it's going to be as rapid, this point of where the price collapses, as people expect. But at the same time, that's because I think that it won't be so easy to pick up on the financing and get everything in place. What's going to happen? Is this level of saturation, this equilibrium, is it consistent with the long-term carbon reduction plans that the government has and its commitments with the European Union? And the answer is, well, may or may not. I can think of lots of situations in which you can sort of create a scenario where that happens, but I can create other scenarios where the level of saturation falls well below that particular target. And then the real issue is, what's the government do under those circumstances? And will the actual uncertainty over this particular future unknown intervention influence investments today? And I think that's a very relevant point here, because if there is going to be in the future a missing money problem, you will take that into account. You cannot amortize your investment cost over 40 or 30 years. You really have to think about, what are the chances of regulatory intervention and me suddenly being out of the market? And then what I'm suggesting to the audience is, go out, get informed. There are ways to understand these issues around cannibalization. What's the impact? Yes, you can literally use the simplified framework I've given you to understand these things. Is it simplified? Absolutely. Go and think about other things. Go and think about how demand's going to grow over time. We can have conversations about electric vehicle penetration. Think about fuel prices and EUAs, EU allowances, CO2. Will we or will we not have to be incorporating different taxes? Is it good for photovoltaic or not? IEDs, Industrial Emission Directive, and coal. So, how quickly are we going to close coal-fired power stations in Spain? Obviously, the bigger the gap with respect to the existing capacity, the more space there should be for photovoltaic. Don't forget that we have a lot of legacy old renewables and old cogeneration plants in Spain. Okay, 7 gig is basically cogen, right? That's quite old. That's been around for a long time. Some of that capacity is going to be coming to its replacement cost within the next 20 years. They're going to have to be replaced. Hydrology. Climate change is not a fiction. We know about dry and wet years here in Iberia. Are we going to have more dry periods? We have to wonder. Then we go back and focus more instinctively on what's going to happen with respect to the renewable sector. I think PV will be able to peak shape during the daytime. I think the wind blows at night, and eventually wind will come into play on a commercial basis as well. It depends, however, on how much is it going to cost, how much leverage, how much debt will I be able to raise. And obviously that's got to do with the team of minds between land and developers, all of us trying to tackle this particular issue of, how close are we getting to a particular cliff edge? Are the results that we're looking at sustainable? Are there other ways to hedge our exposure via PPAs, etc.? And then the other thing to bear in mind is all of this must come out, you will be able to come out with a particular view as how important this issue of the rate of deployment of new photovoltaic or new wind is going to be over time. So what's a reasonable number? Is it 2 gig per year? Is it 3 gig per year? Or is it only, 1.5? Is it for each technology or all of them together? All these type of issues should be thought about in the context of taking a view as to how it is that a merchant type evaluation of the photovoltaic future will actually look like. I'm not a skeptic, by the way. The future will be renewables. It's just about how we get there. That's what I'm here to try to shed a little bit of light on that for you. Thanks very much. That concludes my presentation.
Thank you, Kim. Thank you. Thanks for a well explained and thorough presentation on the theory, the basic theory of cannibalization. Just as a reminder, please, if you have any questions, please use the question box. I personally have a couple of questions, but we'll get to them at the Q&A. So moving on, now it's my time to present Manuel Cabrerizo, partner at Voltic. He has more than 20 years of experience with structured finance and investment banking with Baltic and with West LV. He has closed more than 50 financings in his career, and at Baltic, he's currently structuring renewable energy transactions in Spain, Italy, Brazil, Chile, and Panama. So, Manuel, the floor is yours. Very excited to see your presentation as well.
Good morning, good afternoon, good evening, everyone. Thank you for attending this webinar. Thanks also to Solarplaza for organizing it, and as well as for giving Voltic the opportunity to conduct this session on PV cannibalization, specifically in the Spanish market. And thanks also to Kim of Econ for framing the discussion at the macro theoretical level, so to speak. What we're going to do is the exact opposite. We will try now to bring it to the concrete reality of the Spanish market. Just a second, let me. All right, well, after several years in which not much was happening, the market in Spain is not only hot again, but it's also getting hotter by the day. 3 auctions for several gigawatts have been run by the government, and many parties are now looking at transactions in Spain. On the other hand, as a result of 9 years of QE, volumes are not small. And so everyone knows that the number of projects under development is also large. In fact, last week, the Secretary of State for Energy said at the IRENA Assembly in Abu Dhabi that only in PV, Spain had between 10 and 12 gigawatt ready to build. He also said that an additional volume of between 50 and 20 gigawatt were under development. So obviously, if there is money and projects, a few gigawatt will be connected every year. The current thesis goes, as you can see on the screen. So, and that is when the cannibalization fears actually emerge, as Kim has explained. Well, let's run a reality check before we start worrying. So if we look, for example, at the evolution of the Spanish grid over the last few years, what we see is that neither the number of connection points nor the total extension of the grid in kilometers have grown much lately. The Spanish grid is adding some 20 high voltage points per year on average, and less than 100 in medium and low voltage. Looking at the chart on the left, which, by the way, comes from REE, which is the TSO. In Spain, so these are official numbers. This is no estimate by any market source other than the operator. If you look at the chart on the right, which is not in the number of actual connection points, but the number of kilometers, the actual extension of the grid, the evolution shows a similar picture. There is, of course, a lag between decisions to invest in expanding the grid and the full implementation. In Spain, that gap is between 3 and 7 years, depending on voltage and other factors. So we actually may see the grid grow much faster in the coming years than we have seen in the past as a result of decisions that are being made now or have been made in the recent past, the impact of which we haven't seen here yet in these numbers. Another important point is where we are in terms of installed capacity. Kim was hinting at this. Here, renewable and conventional power are almost even, as we see on the chart on the left-hand side. In terms of gigawatt, we have very similar numbers. If the split is almost 50-50. But in terms of consumption, and we're looking at the chart on the right, it is still majoritarily served from conventional sources. 2018 figures are not available yet, and there are the expected variations depending on rainfall and other factors, as explained by Kim. But the fact of the matter is that in 2017 we had around 51 gigawatt of renewable power in terms of installed capacity, and around just short of 48 in conventional power. And the amount of effective supply to energy consumers was around 1/3 from renewables and around 2/3 from conventional. 2017 was a specifically dry year, and there was some trouble with other sources of renewables. So that proportion is unusually large. Probably 2018 numbers will show a different split. Probably much more, a larger market share for renewables in annual numbers. But the fact of the matter, the point to take away is that still more than 50% of production in terms of actually meeting consumption demand patterns still comes from conventional in Spain. Now, once the starting point is defined, we think, by the situation of the grid and the actual market share of renewables, let's look into the practical aspects of making a project work. The vast majority of investors we talk to require contracted revenues. In the current situation of no feed-in tariffs, these need translates in PPAs, effectively being sought by an ever larger number of projects. However, the number of bankable off-takers is very reduced, among others because large industrial consumers tend to be very largely concentrated on the short end of the curve. They accumulate significant spot exposure and are very concentrated on the 2-year future hedges in OMIB. OMIB is the organized market where futures are traded in an organized manner. That position, which is starting to change slightly now, determines that the few off-takers in the market actually enjoy a very considerable bargaining power. Well, this is a perfect definition indeed of a buyer's market, which obviously limits returns and upside for projects. And I'm sure that many of you have made that experience in conversations you've probably had or are currently entertaining with off-takers. Of course, things can be done to stimulate off-takers to hedge prices over longer tenors. I mean, the government could implement fiscal or accounting incentives. New auctions can also be arranged. In fact, the Secretary of State also announced last week that the renewable auctions for more than 3 gigawatt per year were to be organized. So even tariffs could be reintroduced. Whatever the option, the point is that these levers all have a common denominator, which is that they imply regulatory risk. Now, with many players in arbitration proceedings against the Spanish state for past changes to regulation, what's the real appetite for this in investment committees? I won't provide an answer to that question, but I think it's rather obvious. Therefore, in our view, for many, the choice will be, in practice, between regulatory risk and merchant risk, or combining both in variable degrees. Now, this begs, however, another important question, which also Kim was hinting at. Is the money, both equity and debt, willing and able to take merchant risk, albeit in limited doses? What we're seeing are, in practice, movements from the contracted end of the market towards the merchant end. But that transition is slow and often painful, at least for now. This could change rapidly, both for lenders and for investors, though, mostly due to excess liquidity and need for high returns. Excuse me. And there, another final factor to the right-hand side of that chart is, and last but not least, is it may take some time, as we were saying before the grid is actually ready to absorb new power in such scale. Our conclusions are therefore that renewable penetration may be slightly slower than expected, although this setting may improve relatively quickly. This implies that the supply drop, the supposed drop in spot prices driven by massive volumes of renewables coming on stream may take longer than anticipated, even without disruptive events on demand side like electric cars. We also think that merchant elements will need to be part of a structure in a large number of projects, even if the announced auctions finally see the light, because they'll probably result in very low power prices, needing merchant exposure to meet return hurdles. And then as to the subject of this webinar, which is cannibalization, we understand it as the negative impact new PV projects would have on financial performance of older plants, given the lower price acceptance level, as explained before. In this sense, it would be a self-induced effect in practice, coming from the PV industry itself, not from competitive pressures created by other technologies. So from our point of view, as long as these competing technologies can be driven out of the market by PV, we think that competitive pressure will work primarily against them and not against older PV plants. So in the Spanish market, we don't think that PV cannibalization will be a necessary evil to promote PV growth, as long as PV remains competitive against conventional power generation. And we've seen before that the bulk of the power consumed in the country still comes from conventional sources. Or with different words, the way we're saying it in that slide is that the marginal unit of PV that PV3 Kim was talking about, that creates the price collapse, is still, we think, very, very far away. That's all for us from now. Thanks for your attention. And we'll hand it over back to Leoncio in order to have at least 10 minutes for the Q&A session. Thank you.
Thank you, Manuel, again for a great presentation. And for everybody, if you want to learn more about Voltic, the services, and what it is as a company, please check the handouts in the webinar software. There is a handout there that you can directly download. So we're moving on with the Q&A, but before we start with the Q&A, and we do have a lot of questions, we would like to launch the poll again. The same poll that we launched at the beginning of the webinar. So you should be seeing it on your desktop right now. So I'll give a minute or half a minute. And we want to see what has changed, if anything. Manuel and Kim, do you expect any difference? In the first question, we did see the regulatory framework and market dynamics were the main things. Do you expect any difference now? Manuel, Kim?
Sorry, I couldn't hear that. Can you repeat that, please?
Well, do you expect any difference in the poll from the one that we launched at the beginning, where regulatory risk and dynamics were the most important things? Do you expect any difference now after both of your presentations?
Well, I hope there is, because Kim's presentation was actually very, very convincing.
Thank you so much.
Okay, let's see the results. And yeah, surprisingly, we do see an increase in market dynamics or in the price projections, and also merchant risk. Managing the merchant risk takes a bigger role. So, well, this seems to indicate that the audience has learned a lot with your presentation. So, okay, let's move on with the Q&A. So let's start with a couple of questions that we have over here. I think one of the most important questions, Kim and Manuel, was about the apuntamiento, no? Which in Spain, it has been equal or a bit bigger than 1, no? The ratio being 1 in the last couple of years. But still, I was just reading today that in Spain is generating 2% of the overall generation. However, with the expected increase in capacity, what will be the effect where PV makes up 10, 30, and 50% of the generating capacity in Spain? So maybe Kim, you can go first.
In that situation where photovoltaic plant, is 50%, you're gonna have the assumption must be that all that capacity. I'm going to tell you why it is that doesn't make sense first, but very simply, if 50% of photovoltaic is actually where you want to be, let's assume that actually meets all the demand in the daytime. It's a reasonable assumption. Because you can't be sure it's going to be there, so you need a lot of excess capacity. The thing is, the sun doesn't shine at night. So if the sun doesn't shine at night, how do you meet the demand in the nighttime? And the answer is, well, you need other technologies. It's either going to be, the first thing is it's going to actually be wind, in my opinion. So wind will come in like a quasi base load. So what the nuclears are today, I think in the future will actually be provided by something more like wind. But we're going to need storage as well. So the whole setup of how we've conceived of what this installed capacity is on the basis of something that actually provides active power, it's going to be quite funny, because I think storage is going to have to come into that equation, and it hasn't done so yet. So just initial storage, Spain's got a lot of hydro. So we're not going to see a lot of deployment of batteries in Spain for this optimization particular issue yet. But yeah, it definitely will be an important one in the future. Will the prices collapse in the middle of the daytime? Well, if they do, some clever chaps with batteries are going to basically buy low and sell high. That's in short what's going to happen.
Yeah, okay, and interesting to note that storage might not play a big role, because of course hydro can also play as a as a storage device. A question, moving on to the next question, Manuel. Do you see currently that the financial institutions have an appetite for merchant risk? And what would be needed for them to accept higher exposure to merchant risk?
Yes, the answer is yes. I was talking about that transition between the contracted end of the market and the merchant end, and I meant it not only for equity players but also for lenders. Many lenders in this country are considering that. Not many are funding it yet, but there's still already a couple of institutions that have made the trip from one end to the other end. So yes, it is possible to raise merchant financing in Spain today. Not that the market is very wide or very deep. There's not a lot of liquidity at the fully merchant. And what I mean by fully merchant is 100% volumetric risk and 100% price risk, so no hedge whatsoever. But there is debt at that end. And there are a number of institutions that are making the trip towards the merchant end, and that would take a limited element of merchant exposure from the financing side. It all comes down to sizing, which is obviously a function of the power price projections you're going to include in your banking case, and that is a discussion. But same as we've seen in other markets like in Chile or in the Nordics, we're also seeing and will continue to see increasingly more merchant transactions in Spain. Yes.
Yes. Okay. And of course, part of the risk that comes with cannibalization could be mitigated, right, through PPAs as bilateral agreements, as you were saying. Right now, being a buyer's market, do you think that the development of a PPA market, sort of in Spain, can eliminate this risk that comes with cannibalization and merchant risk? And what are also, talking about PPAs, what are also one of the most common PPA structures that developers or asset owners are contracting in your experience, Manuel, as well for you?
Well, the point is in the presentation is that this country has no tradition of PPAs. I mean, there's no OTC. There hasn't been an OTC market for power. So bilateral arrangements have been extremely scarce. I mean, there are very few examples in the past, and the reason is essentially that industrial off-takers and therefore utilities are not very concentrated in the short enough curve. As I said before, that's changing slowly. And in the wake of lower prices, we will see a couple of industrial off-takers entering, and we have seen already a couple of industrial off-takers entering into, say, 10-year PPAs, where they acquire renewable power at what they consider cheap prices compared to today's spot levels or historic prices. So that is happening slowly, but at the same time, we don't think that the PPA market will have in itself, and on the side of the off-takers, sufficient volume, so to speak, to serve the sheer amount of megawatts that are under development in the country. And that's why we said that something has to give, in the sense that either equity and debt accept lower contracted revenue levels, or there are additional ways to secure or to mitigate cash flow volatility, be it through regulatory risk or other manners, because probably the PPA in itself, the PPA market in itself, is not going to have the size required to serve a significant portion of the emerging renewable market.
Yeah, and one thing to bear in mind, Manuel, I think you might appreciate this one, especially when you look at experiences in other countries, is, if the spot price collapses, people are going to feel pretty stupid if they signed long-term supply contracts. Those contract managers, those purchasing managers are going to get fired or sanctioned. So nobody wants to be left on the wrong side of a contract. So, it's a chicken and egg. There's another type of chicken and egg problem. If the wholesale price is very low, by definition, you're not going to see a lot of people signing contracts at above market rate. It's always going to be influencing, and there's always going to be some sort of indexation or feedback loop between what's happening in the spot market and what's happening in the contract market.
Mm-hmm. Correct. We're seeing those dynamics too.
Okay. Talking about, sort of as a follow-up, is there any, at least talking about the Spanish market, is there any sort of maximum level of PV before investors start, this is a question from the audience, before they become reluctant to investing in these variable, renewable energies, talking about wind and solar? I think this is sort of a key question, right? Is there a maximum limit? I mean, I don't know, for any of both of you.
Well, conceptually, the answer is yes, as I've tried to show. And then the real answer as to how much. If you tell me, Kim, can you see 40 gig of photovoltaic capacity in 2050? I go, yes. But what's interesting to me, and for most of us in these audiences, we'll probably be dead by then. Our children will be alive, so it would be nice for them to know, what this green future will look like. But I think the interesting thing there is what's going to happen, and what is it that's going to be required to be put into place to get us down that transition. And that's where it's interesting, because we have to make decisions today on the basis of what's going to happen over, say, a 15 or 20-year window. And that's the challenge.
To me, it's going to be, I agree with that, it's going to be a lot slower than is actually expected, because there's still a lot of conventional power to be driven out. Of course, you can't have a 100% renewable generation mix, but it is also a question of how the other elements that are necessary to make projects work are actually slowly finding the right place in the market. However, market information is always imperfect, and by definition, every market evolves until it eventually creates the excess capacity. So that can happen. Now, the one factor we see that can change things, by the way, we think that, as we were saying at the end of our presentation, that marginal unit of PV or wind or whatever renewable technology it is that creates a kind of price collapse and eventually, makes it power prices effectively plummet in the spot market is very, very far away. So we think that in the meantime, we're going to see some revolutionary moves, probably on the demand side created by electric vehicles, because right now, most of people are projecting with perhaps 1% cumulative growth per year for demand, but that can change. And batteries are probably, or say more, say a better management of the hydro capacity, as Kim was hinting at, might also alter or spark some price arbitration between times, between hours within the day or nighttime, in order to take advantage of those price differences. So we think that by the time this happens, that price collapse eventually happens, the market will look very, very different.
Yeah, beware non-market factors, which are still relevant, such as rooftop solar, by the way. So if we see a huge expansion of rooftop solar in Spain, that takes away demand from the wholesale market. So it works the same way. But if the government, if residential consumers have a different set of criteria to decide whether to put rooftop on their roof, on their ceiling, or on their roofs and stuff, it'll change the dynamic. So we're not only thinking utility scale. You have to keep an eye out for what's going home in the residential market as well. We're not there yet. Subject to all these issues, the solar tax has been taken away, but it takes a long time to develop the infrastructure to put sort of PVs on top of everybody's roofs.
Yeah, definitely. I agree. And I think also interesting to look at what's sort of a worldwide trend on the digitalization and, using artificial intelligence to sort of, balance the grid and demand response, and all of this can really have an impact and I think also to maximize PV's potential. But we're running out of time. I think let's just keep it to one last comment. What is your key takeaway to both of you? Key takeaway, and what would you like the audience to take away home?
Well, since I started, let me just conclude on my side. Don't be scared. Don't be scared about being able to look at this very complex, multidimensional problem. There are ways to actually understand what's going on. So, we can take a reasonable view as to how that is, but, my main thing is get informed, find out how these things are. Don't just read a 100-page report and think you know stuff. Get involved, ask questions, test your hypotheses, listen to people. Obviously, I'm doing a pitch for you guys, Leoncio, with respect to the interest in meeting and conferences and people. We need to network to try and see where the market's at.
Yeah.
Keep asking questions.
Perfect. Thank you.
We're also positive about market evolution. It will look different. We're certainly moving away from the old world of contracted revenue, but there's a pretty bright future, and probably excess liquidity both on the lender side and on the investor side is going to spark anyway, because everybody needs to meet certain return hurdles, and QE is doing wonders in that sense, because too much competition is pushing down returns significantly. So investors themselves will probably are already understanding that they have to take merchant risk, the same as they're taking probably development risk by buying into project development pipelines earlier than they used to. So those are two ways of enhancing returns. So we are seeing those, and it's not unwelcome from either the investor or the lender side. Of course, there's still a road, there's still some way to go, but we see our hybrid structures, meaning combining contracted parts with merchant parts as the future, and there is a significant market for that, and transactions will continue to happen as have to now, and probably even faster.
Great, thank you. I think that's a great way to end the webinar with a positive and a hopeful note. I would like to thank everybody here listening to this webinar. Thank you all for joining. I would like to thank both of our speakers, Kim Kitts and Manuel Cabrerizo. Thank you both for great presentations. And I would like to invite everybody to visit our website for more content and information. Thank you, everybody, and see you next time.
Thank you.
Thank you. Goodbye.
Thank you.